It's not easy being a bear out there with the bulls trying to rip our face off again today. However, we will continue to follow the data and hang in there. Welcome back to Click Capital, everyone. My name's Jared and I'll be taking you through all the most important data and charts from the markets today. And stick with me right through to the end, and after watching you will have a good idea of exactly what's going on out there. And a big reason why we rallied today is this guy right here, Apple, with its earnings beat yesterday and coming in a lot better than expected with iPhone sales. We finished up 4.6% today, and if you're watching the video yesterday, 170 was the big level that we were watching as it hadn't closed above that level all year. However, we gapped up at 170.98, and just looking at the 15-minute chart here, it gapped up, ripped, and didn't look back and just held up all day. Also helping the market higher today was the non-farm payroll report coming in a lot better than expected. We were expecting 185,000 new jobs created. We actually came in at 253,000. And that sent the unemployment rate down to a new cycle low of 3.4%. So that and the news that the Fed could be done hiking rates and signs that the job market and economy is still okay got the market a little excited here today. However, don't forget that it's actually when the Fed does pivot that the market does tend to sell off, and that's because the economy is going to weaken. That's why they decreased the interest rate. And we can see back here in the early 70s, after the Fed pivoted, the market fell 36%. Again, in the mid 70s, the S&P fell almost 50%. In the early 80s, 27%. After the tech bubble in the early 2000s, it fell 51%. And when they pivoted in the GFC, we fell 58%. And in late 2019 with COVID, we fell 35%. So if the Fed is done hiking rates and they are going to pivot and pause, that means they see weaker economic conditions around the corner. And it's typically when the Fed then starts cutting rates that the market then sells off. What else has also been helping this market is a better than expected earnings season. So far in Q1 23 season, we've got 85% of companies that have reported, and 79% of the SP 500 has reported an EPS surprise. That's a bit above the long-term average around 75-77%. However, it's still the second straight quarter the index has reported a year-over-year decline in earnings. And so far in this quarter, it's minus 2.2%. And that is a lot better than expected, because on March 31, it was expected we're going to decline about 6.7%, which was about the same for Q4 22. And we've now got the forward 12-month PE for the SP500 at 17.7, which is about average long-term valuation compared to itself. But you can't value stocks in a vacuum. It's all relative to the risk-free rate you can get from government bond yields. And this chart here illustrates that point with the S&P 500 earnings yield minus the US 2-year bond yield, and that is just above zero at 0.25%. And so most of this bull market cycle, that's been really positive, meaning there's a much bigger return to be had in stocks versus the bonds, and you are compensated for that business risk that you take on. So relative to bonds, stocks are the most overvalued they've been this entire bull market cycle. But that didn't stop the market from getting excited here today with those Apple earnings and better than expected jobs report. Pretty much green across the board here with blanketed bullish breadth. And all of that induced some short covering in the regional banking sector ETFs. We saw finish up over 6% today with huge moves in the most vulnerable regional banks. We saw PacWest up 81% today, Western Alliance up 49%, and Zion's up 19%, and the entire sector up pretty strong as well, as it looks like a bunch of shorts have covered and maybe some value buyers stepping in as well. And those moves today pushed the fear and greed index back into the greed zone at 59 here. However, dark pools aren't buying it, with a bit of a divergence here today and pulling back. They're buying. Contrasting that was corporate insiders actually exceeding sales yesterday. Options market getting excited with that on another busy Friday with 42 million contracts changing hands, 54% of them being calls. However, these days the option market is highly focused on just the next couple of days. We can see 57% of volume is in contracts that expire in 5 days or less. And we can see that is in a lot of bullish bets just over the next day. So 63% of today's volume was in single leg call trades that expire in the next couple of days. And a lot of that is in the mega cap tech stuff. So people betting that these stocks are going to continue going up over the next couple of days, with Tesla at 43% puts, Apple at 44%, NVDA at 40%, Amazon at 39%, and Microsoft at 40%. And we can see applied volatility across the board is near 52-week lows, as measured by IV rank percentage, and that basically shows you where current IV is compared to the 52-week low and high. And pretty much all sectors are near their 52-week low except for financials at 25% and real estate at 25% as well. And across a lot of international markets and different assets as well, we're near 52-week lows on implied volatility. Everything except gold, which is currently at 70% IV rate. And with that jobs market report coming in a lot better than expected, we did see the probabilities jump that we get a hike in June to 8.5%. I would have thought that would have been a bit higher because JPOW didn't say that they're on pause yet. They are going to be looking at the data and leaving the door open on the June decision. So if I knew ahead of time that the non-farm payrolls was going to come in at 250,000 new jobs, I would have suspected that got to at least 20-30% probability of a hike. So it looks like the bond market is still worried about this banking crisis, even though we got a bit of a short covering rally hit there today as well. And that's what the stock market could be liking, that we've still got a healthy consumer that still has a job and possibility that the Fed is done hiking rates. However, don't forget unemployment rate is a bit of a lagging economic indicator because the tightening credit conditions will take a few months to show up in the real economy. And with the regional and community banking sector pretty much being choked, and they do account for about a quarter of all lending done in the States, that should have a significant effect in the upcoming months, especially in the small businesses. And the banking crisis is far from over. The net effect is going to be really hard for regionals to succeed going forward because the too big to fail premium is being monetized by JP Morgan. They can offer way lower rates on their savings accounts, charge a healthy rate on their loans because big customers want to park their money there because they're a lot safer than the smaller guys. And so now the smaller banks have to offer higher savings rates, competitive lending rates, plus they have a higher cost of capital. The net result, there will be more consolidation in the banking sector, which has been a long-term trend. And we can see that here in this chart when the amount of banks actually peaked out in 1983 at a bit over 14,000. And of last measure, we're just a bit over 4,000. And next time we get updates on this data, that's probably going to be accelerated to the downside. But the entire bond market is now saying the Fed is done, as indicated by this chart here. The thick red line is the Fed funds rate, now above 5%, and the entire yield curve is now below that from 3-month all the way out to 30-year. So the bond market and yield curve does a pretty good job at front-running the Fed, and it's normally the Fed that follows the market, not the other way around. So even though we did get that good jobs report, that is a bit lagging, and the bond market is continuing to say this banking crisis is going to cause a contraction in credit, which will continue to see a decline in GDP growth rate. Last reading was at 1.1%. When that goes negative for 2 consecutive quarters, we are officially in a recession. And even though gold is close to breaking out to new all-time highs, there isn't many people talking about it in the media and online. Apart from a few financial observers like myself, we can see here in the white is the amount of times gold has been in the media as a story is actually near lows over the last decade. And here's the gold price in the blue line. And we can see that in Google search trends as well. The amount of people searching for gold hasn't reached near the peak it did last time gold was rallying. However, it's still yet to be seen whether gold is going to break out to new all-time highs here. We got to $20.85 an ounce yesterday, just $4 short of the all-time high, and we've pulled back a little bit here today and kind of just stalling out at this big resistance zone. And here's the monthly chart of gold. We're still sitting around 2,000 an ounce. And what looked like a big double top in March last year, the market has coming back to test it, and the more time it tests it, the weaker it gets. So I do expect it to get through there. At some point, it just may shake out a few longs before it does that first. And crude had a good bounce here today, up back over to $71 a barrel. Maybe the government did do the right thing and bought the dip to refill their strategic petroleum reserve. And Buffett would be enjoying that move as he's now got over 40 billion of his portfolio in energy stocks, and that's grown significantly over the next couple of years. So over this last 6-9 month dip we've had in the price of oil, Buffett has been buying the dip in energy stocks. So he clearly sees higher crude prices ahead. And Carl Icahn, fighting back from being attacked from Hindenburg, issues a surprise dividend of $2 per unit to investors and came out and said, "We would like to reassure our long-term unit holders that the market disruption caused by the self-serving Hindenburg report does not affect IEP liquidity." And that looks to have caused a bit of a short covering rally and bump up in the stock as well, up 26% here today. So the fight is on Carl Icahn versus Hindenburg, and it'll be interesting to see how this unfolds and finishes. And we've actually got Icahn Enterprises reporting earnings in 5 days, so I'll keep you guys updated on what happens there. And just back to mega cap stocks here, looking at a monthly chart of Apple. Now that we've cleared 170, the next big resistance zone is around 180 near its all-time highs. And that'll be the big major test, as it could potentially form a double top. And we can see a similar pattern in NVDA as well on the monthly chart, coming up to maybe form a double top, and Microsoft as well. However, the other big popular stocks like Tesla are nowhere near their all-time highs. Same with Amazon as well, and Google. Also Meta, AMD and Netflix as well, nowhere near their all-time highs. And so the SP 500 is back to stalling out in this big resistance zone as well. Same with the NASDAQ, but it just found new highs for the year today. However, when you look at the NASDAQ equal weighted, it's still just below its 50 bar. However, we'll come back to the main indices at the end of this video. International indices got a bump today, but still stalling out up here as well. And surprise, surprise, the VIX and volatility gets crushed on Friday again. So Fridays are typically a busy day for the options market, with a lot of options expiring and a lot of people wanting to close positions before the weekend. And a pattern I've been noticing over the past couple of months is the VIX just getting absolutely crushed on Fridays. And we saw that again today with the VIX coming off 14% down to 17. And I've just put in blue lines here with the last 5 Fridays. And every one of them, the VIX has come off and almost closed near its week lows. And we just saw the same pattern here again today. So it's very convenient for the option dealers to have VIX crush on Friday. And the amount of premium on out of the money options gets that maximum decay for the option sellers. So the way the option market's changed over the last couple of years, with a lot of volume moving to 0 and 1 day to expiry contracts, I think the VIX has lost a bit of its strength and signaling. And so I'm not looking too much into that. And we can actually see realized volatility picking up a bit here today, but still pretty low at an annualized rate of 13.5. And just not much fear out there at all. Not many people buying puts, with the put call ratio at 0.86. Did get a bit of a bump up in breadth today, but still nowhere near as strong as the actual market itself, with 46% of stocks above their 20-day average and still less than half of stocks below their long-term average. Stocks making new highs is still pretty subdued as well. Growth versus defensive sectors got a little bump up today, but still below their 50 bar. And with Apple and mega cap tech holding up well, we're seeing the growth versus value stock spread actually about to hit new highs for the year here. And small caps still trading really weak versus large caps, trying to find a bottom down here, still well underneath their 50. International stocks still holding up strong versus American stocks. Had a bit of a pullback in the yield curve today and a bit of a bump up in high yield. And with that strong jobs report, we saw government bonds show some strength here, with the 2-year popping up to 392 and the 10-year holding this big support zone around 340. We got the June Fed Fund futures contract holding steady at 507, but we did see a little bit bump up in the September and December contracts, as the market gives a little bit more of a chance to the possibility of a June hike. But I guess a lot of that June hike is going to depend on the banking crisis, because even though we've got a strong jobs market and the economy is holding up okay, the bond markets really look at what's going on in the banking sector, as all the regionals and community smaller banks getting suffocated may do the Fed's job for it and bringing down inflation. So if you want ideas on what the Fed's going to do, look at the price action in KRE, the regional banking ETF. I've overlaid the chart here with the US 2-year government bond yield, and we can see prior to Silicon Valley Bank it wasn't too correlated, but since Silicon Valley Bank went under, there's been a strong correlation between the two. So the bond market's really paying close attention to this banking crisis as the biggest driver of what the Fed is going to do next. So with that back and forth in the market, we continue to see the TLT trade sideways. And high yield just reclaimed its 50-day today. The dollar continues to hold its major support level at 101. And Bitcoin continues to trade inverse to regional banks, consolidating around the major 30,000 level. And commodities can't be held down for too long. They dip bought again, had a bit of a strong pop-up here today, back into this long-term support zone. The exception was the precious metals, gold and silver, having a bit of a pullback here today. And that strong move up in crude after that big hammer formation yesterday after we took out March lows. And sometimes when you see markets quickly ping off big support levels, they can quickly rebound in the other direction. Natty gas still trying to find a bottom down here, and agricultural commodities continue to trade strongly in an uptrend as well. Uranium had a nice move up here after forming a bottom over the last month, and gold miners was the only sector that finished down today, although it was dip bought. We had a pretty big pop up in the overvalued stuff, with ARC up 4.6%. Semis moved up a little but still under their 50. Big banking sector XLF reclaimed its 50, as did industrials and REITs as well. And defensive sectors continue to trade well, with healthcare, staples and utilities. And that's a trend I've been noticing lately, is these food and beverage companies that sell low-priced items have been trading really well, with a lot of them hitting all-time highs. This is a monthly chart of McDonald's, then we've got Mondelez, Monster Beverage, PepsiCo, and General Mills all hitting new all-time highs recently. And I think because these companies are doing well, and if we were to go into a recession, they should still hold up okay, as people still have a few bucks to get a drink or a bite. BlackRock looks to find a bottom with a little bounce up here today, and JP Morgan, basically the only bank above its 50-day average, had a pop up here today as well. Had a pretty good move up here, and Tesla today finished 5.5% higher and may look to fill this last earnings gap, come up and tag its 50. However, I still think it is in a downtrend here, and I'll stick with that view unless we can really take out this 190 level. NVDA as well had a pop up here today, up 4% on below average volume, but continues to trade sideways in this box I've got here, and I can see on the range strength we're starting to go green, and we can see price creep closer and closer to the 50-day, so momentum is still stalling out. However, I would not be surprised if we come up and tag 300 next week, as this will continue to try and shake shorts out. Meta defied the market and pulled back a little bit here today, and AMD continues to trade well, up 3.7% today. On back that news yesterday, they're going to partner with Microsoft in building AI chips. So now Microsoft's got OpenAI with ChatGPT. They're going to partner with some hardware like AMD to try and take on NVIDIA. And I can imagine they're not the only ones coming for NVIDIA as well with their huge overvaluation. Coinbase had a good pop here today, up 18% on better than expected earnings, although they still lost 34 cents a share. And like Jim Chanos, I'm still bearish this stock. I'm waiting for it to go up into the 60s where I may take a short position on it. And meme stocks had a pretty good day today here. Here's one of the original meme stocks, GameStop, up 5% today, as there's still amazingly buyers out there for this stock. Carvana up 24% after their earnings, but they still lost $1.51 a share. And C3AI still hanging in there, but really consolidating around this $18 level. DraftKings had a nice pop up here today, 15% on earnings that came in line. However, when you go out to a monthly chart, it's still nowhere near its former glory levels, up in the 60s. Shop climbed another 8% today after better than expected earnings yesterday, and I continue to keep this one on my short watch list as well, looking for signs of a technical top, and I may take a short position in Shopify as well, as I think at $80 billion market cap it is overvalued. And here's a quick look at the big banks. Bank of America with a little pop up here today, but on low volume. Same with Citigroup and Wells and Charles Schwab. So even though they went up today, it wasn't the most exciting price action. So still too early to call a bottom in these names just yet. Okay, let's head on back over to the main indices. So once again, this quagmire of a market continues. We consolidate in this big resistance zone. We're now at about a 250 point gap on the global net liquidity model and SP 500. And the only other times we had similar bearish gaps to that was back in February this year when the S&P sold off a couple of hundred points. And back in August last year when there was a bit bigger gap than now, the S&P actually sold off 800 points. So I think central bank liquidity is the biggest driver of this market, and like Jay said a couple of days ago, they're still looking to reduce their balance sheet and securities. Same with central banks around the world. However, mega cap tech and the better than expected earnings season is holding this market up somewhat. But that's only because of the big companies. We can see here in the S&P equal weight, we're still tracking sideways. Same with the NASDAQ equal weight as well, kind of consolidating. And small cap stocks like the Russell and micro caps continue to trade weak near their cycle lows. And although not easy to be a bear, I continue to remain 60% net short. However, I'm not short the mega cap tech, so it's not as bad as it looks from the big main indices. I actually managed to finish today up pretty good, and I'll continue to have a bearish tilt in my portfolio going forward. Alright guys, that's it for another interesting week. I wish you a great weekend, and I hope to see you again on Monday afternoon. Take care.